You've watched the pitch 100 times. Someone quits their corporate job, rents a warehouse space, hangs a logo on exposed brick, and calls it a movement. 6 months later, they've got a wait list, a merchandise line, and a documentary crew following them around on launch day. What nobody films is month 4, when the lease payment lands and the membership spreadsheet doesn't add up the way it did on the napkin back in October. Here's the thing that almost nobody talks about. A gym with 1 rack and 400 square feet of rubber flooring can be more profitable than a gym with 12 racks and 8,000 square feet. Not more impressive, not more Instagrammable, more profitable. And the math that explains why is the same math that separates the people who make it through year 2 from the people who don't. So let's start at the beginning, the smallest version. 1 room, 1 founder, 1 rent check. The unit economics of a tiny gym are almost embarrassingly simple, which is exactly why so many people get them wrong. You have a fixed container, a space that holds a certain number of people per hour, a day that has a certain number of usable hours, and a calendar that repeats every week whether you fill it or not. That container is your revenue ceiling before you sell a single session. A 400 square foot studio running 6 hours a day, 6 days a week, with a maximum of 8 people per session. That's your universe. Every business decision you make is just a question of how much of that universe you can convert into dollars before your fixed costs eat you alive. This is where the pricing choice stops being a vibe and starts being a survival decision. Drop-ins feel accessible. $20, $30, show up when you want. They're great for filling empty slots and terrible for building a business you can plan around. Drop-in revenue is weather. It changes with the season, the week, the competing gym that opened 2 blocks over. Memberships are the opposite. $150 a month, auto-billed, quiet, and invisible until you look at your bank account on the first of the month and find money that arrived while you were sleeping. The psychological shift from selling sessions to selling belonging is one of the most important financial transitions a gym founder ever makes, not because memberships feel better, but because recurring revenue has a completely different relationship with uncertainty. You can model it, you can sleep through it, you can borrow against it. Small group training sits in the middle, and in the right structure, it's actually the highest margin option of the 3. 6 people at $40 a session twice a week for a month. That's nearly $2,000 from 6 clients using 1 time slot and 1 coach, which is you in the beginning. The same slot sold as drop-ins might generate $60 on a good day or nothing on a Tuesday in January. Now let's talk about what's actually eating your money, because this is where most founders look away. Rent is obvious. Equipment is obvious. What isn't obvious is the insurance premium that shows up in month 1 before you have a single member. The payment processing fee that takes 2.5% off every transaction you ever collect. The software subscription for booking and billing that costs $40 a month regardless of whether you book or bill anything. These aren't large numbers individually. Together, stacked against a revenue base that's still being built, they decide whether month 3 feels like momentum or like drowning. And then there's the cost that never shows up in any accounting software. Your own labor. In the early months, the founder is the trainer, the cleaner, the social media manager, the person who answers the DM at 10:45 p.m. about parking. If you were paying yourself market rate for the hours you're working, you'd see immediately that most tiny gyms aren't profitable in year 1. They're funded by the founder's willingness to work for nothing while the business catches up. That's not a problem if you know it going in. It's a catastrophe if you don't, because the day you hire your first employee to cover what you've been doing for free, the economics change completely, and you need to be ready for that math before it arrives. Break even is the number that runs the whole show. Fixed costs divided by gross margin per member. If your rent, insurance, software, and utilities add up to $4,000 a month and you're charging $150 per membership, you need a floor. A minimum member count just to stay in the room. Below that number, every month is a controlled bleed. Above it, every additional member is almost pure margin because the rent doesn't change whether you have 30 members or 50. This is why the tiny gym can beat the big gym on profitability. The big gym has more members, but it also has more rent, more staff, more equipment maintenance, more liability. The small gym, run lean, with the right pricing, can clear margin percentages that would make a restaurant owner weep. But here's what almost every first-time founder gets wrong before the lease ink is dry. They focus on acquisition and completely ignore retention. Getting a new member costs you marketing spend and your time. Keeping a member costs you a good experience and a text message. Churn is the silent variable that makes break-even math a moving target. If you're losing 15% of your members every month and replacing them with new ones, you're spending twice to stand still. Onboarding habit formation. The first 2 weeks when a new member decides whether this is part of their life or just a January experiment, that window is worth more financially than your entire Instagram following. So before the conversation ever turns to a second location, before you price out that bigger warehouse on the edge of the commercial district, there's a question that functions like a filter. Can you fill what you already have? Not at capacity on your best Tuesday. Consistently, with retention numbers that hold, with a wait list that proves demand is spilling over rather than just shopping around. More space is not a solution to a people problem. It's an amplifier. And if the people problem isn't solved, a bigger room just means a bigger bill for a problem you didn't fix when fixing it was still cheap. The first gym teaches you everything. The question is whether you're paying attention to the right lesson. So you filled the room, not on a good week, consistently. The wait list isn't a vanity metric anymore, it's a queue of people with credit cards ready who can't get in. Your utilization is running above 80% across peak hours, and the cost to acquire each new member has dropped because your existing members are doing the recruiting for you. Those three things together, waitlist depth, utilization rate, and CAC payback under 90 days, those aren't just encouraging signs. They're the specific triggers that make a second location logical instead of just exciting. The difference matters more than most founders ever stop to understand. Exciting gets you a lease you can't afford. Logical gets you a model you can repeat. Here's what replication actually requires, and it's the thing that kills most second locations before the paint dries on the new wall. Your first gym worked partly because of you, your hours, your personality, your willingness to text a member back at 11 at night when they wanted to change their slot. That is not a system, that is a person. And a person cannot be in two places at once, which means before you sign a second lease, you need to have already built the version of your gym that runs without you in the room. Programming documented and scheduled weeks out. Customer experience mapped from the moment someone fills out the contact form to the moment they're 6 months in and referring their coworker. An operating playbook that a manager you haven't hired yet could pick up on a Monday and actually execute by Wednesday. If you can't write that playbook down, you don't have a business. You have a job that happens to have a logo. The hiring reality lands hard around this point. Your first real manager hire is the most consequential financial decision you'll make before location 3. Too early, and you're paying a salary before the revenue justifies it, which is how payroll creep starts. Too late, and you're the bottleneck for your own growth, personally absorbing hours that should be building the next thing. The right structure is a manager with a base that covers the role and a performance layer tied to membership retention and utilization. Not revenue, retention and utilization. Because a manager who chases revenue will oversell and underdeliver. A manager rewarded for keeping members happy and the schedule full will run your gym the way you run it when you're at your best. Trainer incentives work the same way. Flat hourly rates produce flat effort. A small bonus tied to client retention over 90 days changes the entire relationship a trainer has with the people on their roster. Local marketing at the second location is not the same problem it was at the first. You already know your KAC because you've been measuring it. You know what a member is worth over 12 months because you've watched enough cohorts cycle through. That LTV to CAC ratio is the only number that should decide how much you spend to acquire a new member at location 2. If a member is worth $800 over their average lifetime with you and you're spending $120 to acquire them, you have room. If you're spending $300 and the math only works if they stay 18 months and most of them don't, you're financing growth on hope. Referral programs cost you almost nothing and close at a higher rate than any paid channel because the person walking in already trusts someone who already trusts you. Community partnerships with physical therapists, nutritionists, local employers running wellness stipends, these are the distribution channels that compound without a monthly ad budget. Paid ads work, but only once you know exactly what a conversion is worth. Otherwise, you're just buying attention and hoping. Now the dashboard you run changes completely when you have 2 or 3 locations feeding into it. Revenue per member tells you whether location 2 is attracting the same quality of customer or just more bodies at a lower price point. Contribution margin by location, revenue minus direct costs, including that location's rent and payroll, tells you which unit is actually pulling weight and which one is being subsidized by the first one without anyone saying it out loud. Churn cohorts by location show you whether the customer experience is actually consistent or whether you have a people problem at one site that's hiding inside the aggregate numbers. Utilization by time slot tells you where pricing power might exist. A 6 a.m. class that's been full for 4 months is leaving money on the table. Real estate is where second-time operators separate from first-time founders most visibly. A landlord negotiating with someone who has one location treats them like someone who needs the space. A landlord negotiating with someone who can credibly show a second location performing and a third under conversation treats them like a tenant worth keeping. Tenant improvement allowances, the dollars a landlord contributes toward building out your space, are almost always negotiable and most first-time operators never ask. Lease structure matters enormously. A 5-year term with 2 5-year options gives you the stability to invest in the space without the trap of a 10-year commitment to a neighborhood that might shift underneath you. Funding the expansion is the final variable and the most dangerous one to get wrong. Reinvesting cash flow from location 1 into location 2 is slower, but it means you own the growth without anyone else's terms attached. Debt accelerates the timeline, but every dollar of fixed interest is a dollar your new location has to earn before it contributes anything to the business. Over-leveraging at this stage is how good gyms become cautionary stories. The second location takes 6 to 9 months to reach the utilization of the first, and if your debt service doesn't account for that ramp, you're not building an empire. You're building a pressure test with a very short fuse. The mini-empire isn't about more locations. It's about whether each location can actually stand alone before you use it as a foundation for the next one. At some point, something shifts. You can feel it before you can name it. You have 4 locations, maybe 5, all of them performing, all of them individually defensible. But when you look at them from the outside, the way a customer would look at them, they don't quite feel like the same thing. The logo is the same. The color on the wall is close. But the pricing is slightly different at location 3 because that manager negotiated a class structure you never fully standardized. Location 4 sells a protein bar brand that 2 didn't carry because the trainer there had a relationship with a distributor. And location 5's front desk has a script that drifted 6 months ago and nobody caught it. This is the exact moment where a collection of gyms either becomes a brand or slowly starts competing with itself. The shift from operating gyms to operating a brand is not cosmetic. It's structural. A brand is a consistent promise delivered at the same standard across every touch point, every time, regardless of which manager opened that morning or which trainer called in sick. Pricing architecture is where most multi-unit operators get it wrong first. You need a tiered offering that makes sense whether someone is joining location 1 or location 5, one that captures the value-conscious member, the core member, and the premium member without each location manager improvising their own version of that menu. Tiered memberships with clear feature differentiation at each level aren't just a revenue tool. They're a standardization tool. When the price ladder is consistent, your unit economics become comparable across locations, which means your data actually means something. Centralization is the operating lever that most founders resist the longest and regret delaying the most. Because it feels like bureaucracy from the inside and looks like margin expansion from the outside. Billing runs centrally or it runs inconsistently, and inconsistency in billing is where revenue leaks before anyone notices it. HR runs centrally, or you have 5 slightly different versions of an employment relationship across 5 locations, which is not a culture, it's a liability. Procurement runs centrally, or you are leaving purchasing power on the table every single quarter. When you are buying equipment for one gym, a vendor sells to you like a gym owner. When you are buying for 10 gyms and signaling a path to 20, a vendor negotiates like they want to be your exclusive supplier. That difference in leverage compounds directly into margin. Training and quality control run centrally, or the brand promise you built at location 1 slowly becomes a different product at location 4 without anyone intending it. Analytics run centrally, or you have 5 dashboards that can't talk to each other and a portfolio you can feel but cannot actually see. Same-store sales growth is the number that starts mattering in a completely different way at this level. It is the metric that separates a growing brand from a portfolio of gyms that are just adding units to hide flat performance in the existing ones. If your same-store sales are growing, your brand is compounding. If they're flat while you're opening new locations, you're borrowing from the future to look better in the present. EBITDA per location, payback period on new unit buildouts, and churn by cohort are the 3 numbers any serious capital partner will ask you to walk them through before any conversation about growth financing goes anywhere real. Revenue mix is the other margin lever that most operators underinvest in until they are large enough to feel the opportunity cost of ignoring it. A flat membership fee is a floor, not a ceiling. Personal training at the right attach rate carries margins that dwarf your membership revenue per square foot. Group classes with structured capacity create yield management opportunities that a pure membership model never offers. Retail is small, but it's high margin, and it's daily traffic monetization that requires no additional acquisition cost because the customer is already in the room. The gyms that build real operating margin at scale are the ones that treat the membership as the acquisition channel for everything sold inside the 4 walls after it. Customer acquisition at chain scale is an entirely different problem than it was at location 2. CAC inflation is the quiet tax that eats growing brands alive. You test a channel, it works, you scale it, it gets more expensive, the audience saturates, and suddenly you are paying twice as much for a member who is worth the same amount. Creative iteration and channel diversification are not marketing department conversations. They are unit economics conversations. The moment you are spending $300 to acquire a member with a $600 LTV, your payback period doubles and your expansion math breaks. Testing new creative constantly, measuring conversion at every step of the funnel, and knowing exactly when a channel's CAC is drifting upward before it becomes a problem is the difference between a marketing function that supports growth and one that quietly funds its own ceiling. Financing options open up when your portfolio has the metrics to tell a coherent story. Bank debt gets cheaper and more available when you have 3 years of clean unit-level EBITDA and consistent same-store performance. SBA structures work for earlier stage expansion but come with covenants that can constrain operational flexibility at scale. Minority investors can bring capital without full dilution, but every outside dollar comes with governance implications you need to understand before you take the check. Franchising is the version of this conversation that looks like pure leverage from the outside and is an entirely different operating model from the inside. A franchisee is not an employee. Managing brand standards across a franchise system requires infrastructure, legal exposure management, and a quality control function that costs real money to run correctly. The operators who franchise too early often spend the next several years managing brand damage they didn't anticipate and can't fully control. Risk management at this scale is not a back-office function. One serious injury at one location, one lawsuit that goes public before you've managed the narrative, one location manager who creates a hostile environment and documents it on social media. Any of those events at chain scale are brand events, not location events. Insurance structures, incident response protocols, safety auditing across every location, and HR governance are the infrastructure that most founders build reactively after the thing that made them necessary. Build them before, the cost of the infrastructure is small compared to the cost of what it prevents. The chain playbook is not complicated in theory. Standardize the promise. Centralize the leverage. Manage the metrics that predict the future instead of just describing the past. But every one of those things requires you to stop running gyms and start running a company. That transition is where most founders either make the jump or stay exactly where they are. And staying where you are is a decision, whether you make it consciously or not. So you made the jump. You stopped running gyms and started running a company. The metrics are clean. The brand is consistent. Same-store sales are growing. EBITDA per location is predictable enough that you could describe it to a stranger in 2 sentences and they'd understand what they were looking at. And somewhere around location 15 or 20, a different kind of conversation starts finding you. Not from members. Not from vendors. From people who want to buy what you built. This is where the endgame begins. And most founders who reach it have spent almost no time thinking about what it actually means. A 200 million valuation is not a revenue number. It's not even an asset number. It's a multiple applied to a single figure, and that figure is EBITDA. Earnings before interest, taxes, depreciation, and amortization. The cash your business produces before the accounting gets complicated. A gym chain at scale doing $12 to $15 million in EBITDA with consistent growth, low churn, and clean books trades at 12 to 15 times that number in the right environment. That's how you get to $180 million. That's how you get to $200 million. The multiple isn't arbitrary. It's a buyer's way of pricing certainty. The more predictable your cash flows, the more they'll pay per dollar of earnings. Predictability is the product you are actually selling at this level. Not memberships. Predictability. Churn sensitivity is the number that moves the multiple more than almost anything else. A buyer building a discounted cash flow model on your business is running scenarios. What happens to the valuation if monthly churn goes from 2% to 3.5%? The answer at scale is catastrophic. A single percentage point of churn difference compounds across 10,000 members and 5 years into a number that rewrites the entire offer. Which means your retention infrastructure, your cancel flow management, your at-risk member identification system, those aren't operational details. They are valuation details. Every point of churn you hold down is equity you are building in real time. Buyers also want to see what they are actually buying beyond the cash flow. A leadership bench that doesn't collapse when you leave. A regional management layer that runs the day-to-day without a founder making calls. Audited or reviewed financials, not spreadsheets, not QuickBooks exports, actual statements that a CFO can hand to a diligence team without a week of cleanup. Lease structures that are assumable and don't create landmines on transfer. These are the things that separate a business that trades at 14 times from one that trades at 9 times despite similar earnings. Operational maturity isn't a soft concept at this stage. It has a number attached to it. Private equity buyers will change things. You should know this going in rather than learning it after the wire clears. They will look at your cost structure the way you never allowed yourself to because you were building, not optimizing. Staffing ratios will be reviewed. Pricing will be pushed. Expansion pace will be mapped against debt capacity in a way that prioritizes return on invested capital over the founder's instinct about the right speed. Some of those changes will make the business better. Some will make it feel like a different business. That is not a moral judgment. It is just the math of what a PE fund needs to do to return capital to its investors in a 5 to 7 year window. Strategic buyers, another gym chain, a fitness platform, a health and wellness roll-up, are buying something slightly different. They are buying your units, your members, your real estate relationships, and sometimes your brand if it's worth more to them than their own in your markets. Strategic buyers often pay less per EBITDA dollar than financial buyers because they're doing acquisition math, not pure valuation math. But they also move faster and create less operational turbulence because they already know what a gym is supposed to look like from the inside. Exit pathways are not binary. A majority sale to PE is the one everyone imagines, but a recapitalization, where you take chips off the table at a partial valuation and roll equity into the new structure, lets you participate in the next leg of the growth without carrying all of the risk. A franchise roll-up is a different animal entirely, licensing the brand and collecting royalties while franchisees fund the expansion. It sounds like leverage because it is, but it is also brand risk distributed across people you no longer control. Staying owner-operated and treating the business as a cash flow asset rather than a sale target is a legitimate choice that too few founders give themselves permission to make. A business doing $12 million in EBITDA annually that you own outright is a different life than a $200 million wire that gets split between taxes, investors, and whatever deal structure you signed 4 years ago. The late-stage mistakes that break the model almost always come from one of three places. Overbuilding ahead of the cash flow, opening units because the brand feels unstoppable rather than because the unit economics support it, and then watching leverage ratios tighten exactly when the market softens. Brand dilution from expanding into markets that don't fit the brand's actual strength, finding out that what worked in the mid-sized cities you grew up in doesn't translate to a coastal market you entered to impress an investor. And debt that was priced for an optimistic scenario, which is fine until the scenario is no longer optimistic. Here is the short version of everything that actually matters at this level. EBITDA margin and consistency. Churn held below the number that breaks the model. A leadership structure that survives your exit. Clean financials that don't require translation. Those 4 things are what moves the multiple. Everything else is noise. If you've made it this far, you've watched a single rack of weights turn into something that gets valued like a real company. We want to know where you'd stop. Which level is the one you'd actually want to build? Drop it in the comments. And if you want to see how this plays out in another industry, subscribe, because we're doing this again.